Hello, I'm Connie Pereira and I'm happy to welcome you to another edition in the Asian Agribiz podcast series. Today we are addressing freight markets and the disarray in the global movement of grain as well as other agricultural commodities to and from Asia. We have on board Ying and Thang from S&P Global Platts talking to Zara Imtiaz, editor of our Asian Feed magazine. They offer us a glimpse of what freight markets look like currently and what to expect moving forward into 2021. Liz is the managing editor of Asia Sugar and Biofuels, while Ying is global managing editor, Container Shipping.
Hello, Ying and Liz. Thank you for joining us in this podcast.
Hi, Zara. It's great to talk to you today. I'm Ying, and I manage the global containers team at Platts out of the Singapore office. So it's been a very unpredictable past year or so in container shipping, and we've been covering it closely. So thank you for inviting me here to share a bit more about what we've seen today.
Hello, Liz.
Hi, Zara. Thank you for having me. I'm very happy to join you here in this podcast. I work in the agricultural sector within Platts. We look at prices and we report on market activity and trade flows of feed grains into Asia Pacific. So happy to be in this discussion.
That's great. So, like the two of you said, we are going to discuss how the current changes in freight markets are affecting shipping to and from Asia. So we saw as 2021 began, sharp increases in the price of some of the major feed grains as shipping costs compounded the impact of tight supply in the market. Similarly, exporters from Asia are struggling to find containers for their exports to important markets such as the US and Europe. So, Ying, let us start with your perspective here. Could you give us a background on the current rising container shipping rates into and out of Asia? And why is there a shortage of containers right now?
Sure. So this is a bit of a long story, but very briefly, I think we can trace a lot of this back to early last year. If we look back to then, during the start of the global pandemic, global demand for goods dipped, and that decreased volume had a knock-on impact on the demand for container space. So this led to carriers at the time canceling sailings to balance supply with demand. However, in a short period of time, the unexpected happened where demand rebounded strongly in about April 2020, and that drove up freight costs significantly on the main trade routes, especially on like the North Asia to US transpacific trade lane. So if you think back to around this time last year, you might remember the first wave of lockdowns. During this time, there was a surge in demand for PPE, home office equipment in line with increased work from home activity. So that stayed strong and lifted with it shipping costs on other routes too. So there was a trickle down effect in that sense. This persisted into the rest of the year, and we saw another surge ahead of the end of the Brexit transition period last year, where North Asia to UK freight rates peaked. And in the recent months, that's come off slightly. Our North Asia to UK spot freight was last assessed at $10,500 per FEU, down from the peak at around $11,000 per FEU just last week. Equipment shortage, that's a key factor here. And overall, I think rates have also plateaued in some other routes. Earlier, there was a lot of talk about how the Lunar New Year period would temper things somewhat. And we did see quietness, but not weakness, not significant weakness. And up till now, we are still seeing firm demand for container space. And with the imbalance in the container market, especially with logistical challenges, this is taking time to overcome. Already, carriers are canceling or have canceled some sailings recently to resolve the market dislocation.
One of the few key things you were talking about is the US Trans-Pacific trade link. So from this, when it comes to our own sector, we see grain exports from North America to China grow. So Liz, how will this put greater strain on the demand for containers and impact overall grain prices in Asia? We're already seeing a lot of that happening now.
Without a doubt, the Chinese appetite for grains It's expected to be the new constant for this market in the next few years. Within China, we see stockpiling, the concerns for food security, swine recovery from ESF, and the way they feed animals. This will all add pressure on grain supply and prices. Freight costs have been on the rise, not only in the container markets, but also in dry bulk, which is most related when we discuss Chinese imports due to the sheer volume. Containerized grain exports is a much smaller market for corn and soybean. We've witnessed a significant spike in Panamax freight rates. Our assessment of US Gulf to China freight is up by more than 40% in the last 6 months. And from Brazil to China, the dry freight rate is more than 60%, from like $28 to as high as about $50 in late February. So the increase has hit the feed corn prices. Feed costs have been on an uptrend for months. Just to give you a perspective, SK, South Korean feed miller, he paid $295 a ton for corn a few weeks ago. And a year ago, cargoes were about $210, more than $80 lower. So your question about Chinese demand and overall grain prices, yeah, as long as China is there to continue buying from the world markets, it will be supporting world prices. As for container and grains, some Asian buyers are arbitraging bulk versus containers when they import. The rally in container freight has diminished the price advantage. Buyers have switched to bulk vessels, but not everyone, because this is not an option available to every buyer. So some buyers just have to pay up for their cargo. Besides Chinese demand and freight costs, there are many other factors at play, like the weather, which affects production and origination, and domestic demand for feed in Brazil and the US. These will also add pressure on the supply and demand fundamentals.
So do you see easing coming from China, or do you expect this to continue to the rest of the year?
We are expecting Chinese to keep buying the grains for stockpiling and also to feed the hog recovery process within. So yeah, we still do expect a strong demand from Chinese importers.
Okay, so you also mentioned that most of the grain is in bulk carriers and not just containers, right? So do you see the bulk shipment pricing at least coming down or changes in that?
The outlook for freight is quite sketchy, actually. So when we interview traders here, they say that they are very uncertain about freight. And as freight is such a big component of their costs, they are afraid to go short in this market. Also, the crude oil outlook is quite bullish with the recent attacks, the recent tensions in Saudi and Yemen. So we are not expecting freight to come off, not in the short term.
So adding to this question, Liz, could you tell us about the impact of freight on DDGs pricing? Because it's kind of an alternative to soybean with prices going up.
Sure. We tracked DDGs prices in the US. Prices there have been rising in the past year. Ethanol plants were facing very poor margins with high feedstock costs and low demand of ethanol. So the supply of DDGs have been squeezed. DGS prices peaked in mid-February at over $300, higher than where the corn was priced for delivery to North Asia. But in the last 2 weeks, we've seen DDGS prices fallen sharply by about $50. And this is due to the ethanol plants ramping up production after the winter storms in Feb. But the prices of DDGS delivered to Asia is still high. Last week, feed miller paid $330 CFR for DDGS, which was $20 higher than their previous purchases. So this just goes to show the impact of freight.
But in comparison to soybean, you would say that it's still competitive?
At this moment, yeah. So we see like Vietnam, who imports between 100 and 120 KT of DDGS, still has strong demand for this product.
Okay. You spoke about crude oil markets. I think maybe Bao Ying can jump in here. So what other factors should we look out for that are driving the cost up for freight to and from South Asia and Southeast Asia when it comes to import and export of agricultural commodities?
Yeah, thanks, Sarah. Yeah, it's really important to think about the underlying factors that's driving up the freight costs. So, there's a lot of focus right now on the high freight costs itself, and that's very natural because they are at multi-year highs. It's easy to quantify change this way. A two, threefold increase in freight costs is definitely eye-catching. But what this is that it's one of many symptoms in an imbalanced container shipping market at the moment. So recently, someone was asking me how high freight rates have affected arbitrage opportunities between China and the US. It's a fair question, but I think it misses the underlying factors that have driven costs up. So we can take this as an example and play it through. Even if current freight rates worked out for ARB economics, or even if someone is willing to pay, there is still a whole host of other challenges, like actually guaranteeing a space or gaining some kind of predictability of when your container would actually arrive. So, in fact, space guarantees is one thing that we see a lot in the market currently. And we see that manifest as the priority loading premium, which is an added cost on top of the spot rate. So sometimes when we talk to Asia sources about FAK rates for containers, we're told there's no point because only premium rates get you anywhere now. And when we look into premium rates, for some routes that can get up to 50 to 70% of FAK rates. So for example, let's take Southeast Asia to the US, which by the way is a new assessment we just launched this month. It's a first in the region. So we have the Southeast Asia to East Coast North America freight assessed at $5,450 per FEU at the start of this week. The spot freight assessment to West Coast was assessed at about $4,550 per FEU. So these are the levels that we're looking at currently. And if we go back to the example, even if one did pay that priority loading premium and successfully book a container, your cargo's on, you're still not done in some cases. At LA Long Beach Port, for example, there is a queue of vessels waiting to unload, and it could take a 1 to 2 week wait time for ships to berth. And already vessels are diverting to other ports on the West Coast, such as Oakland. And we are seeing vessel congestions or port congestions elsewhere too. So, for example, in Singapore, there is some congestion due to the high volume of vessels. And when you finally berth and unload, you have to then worry about the availability of chassis on land in the US. And all this is if you're shipping from Asia. If you're shipping to Asia, like eggs exporters in the US that we spoke to, things have been challenging for a bit. We've heard from some that it's hard to get space because carriers are prioritizing repositioning empty containers back to Asia rather than take time to load up on the backhaul. So that's where we are today, where governments have stepped in to study the situation, where exporters are clamoring for space, buyers are waiting for cargoes to arrive, even requesting changes to their trading terms, such as longer LCs to accommodate the lack of that predictability in arrival times. The competitiveness of FOB exports from different countries are shifting due to freight costs, due to this freight cost element. So, you have sugar exporters in India also potentially falling short of export targets with a lack of shipping container availability. And back to what we were talking about earlier, even if shippers are willing to pay more, space is a challenge.
So basically, even if you pay a premium, it's not that you're going to get any better service or an added advantage, I assume.
So prices are just one part of the whole thing. It's not as straightforward as that. I mean, there are other factors like when you book a vessel, or when you say you want to buy something for this particular month, you expect it to arrive within a certain time frame. But with the schedule reliabilities now, with congestion at ports, that's a bit less certain. And so it kind of has a widespread effect across the whole logistics chain. And it's not just the sort of the very eye-catching number about the high freight cost. That's the main issue here right now that we're looking at.
So in this case, like you were talking about how these exporters are, like the competitiveness of certain exporters are changing. So how competitive do you think Asian agricultural commodities are going to be in such a scenario? And what kind of countries are doing well, or what markets are doing bad?
I think there are two parts to this question. There's the short and the longer term view. So in the near term, high freight costs will surely impact trading in containerized commodities, including eggs. So whether it's immediately impacts competitiveness remains to be seen. I think as high freight rates are seen across the board, it affects everyone. But perhaps this also depends on trading terms, and maybe Liz will have a better view on this. But on some FOB markets like rice, I've heard how export competitiveness from different regions have been hurt or improved by variances in the freight costs. After all, buyers are looking for that final total bill. Um, and from a freight cost perspective, there are a few other factors too. For example, as Liz mentioned earlier, are products able to use or utilize other modes of transport and what the relative costs are in that kind of calculation. So I've heard of rice buyers in India switching to bulk purchases, for example, although that's actually opened another host of problems where the unexpected demand in bulk shipments then caused congestion at ports. So there are constraints that the market is operating in. So in general, though, volume shipped on containers are far smaller than that being shipped on bulk. And competitiveness is not always measured by price alone. So for some time, US exporters of eggs like soybeans, for example, they weren't able to book space on vessels to Southeast Asia because carriers were prioritizing repositioning the empty containers, as I mentioned earlier, in the very active and in demand and high cost trade routes like from North Asia instead. So to illustrate that, I have our spot container freight assessment. So from North Asia to West Coast North America, our assessment is about $4,200 per FEU currently. And just to compare, at the start of 2020, this price was $1,350 per FEU. So you can see how rapidly that increase is. Today, the backhaul cost, so from West Coast North America to North Asia, that's at $650 per FEU. So you can see that difference there and how that prioritizing of repositioning containers back to the $4,200 North Asia to West Coast North America route is seen in that context. So sometime back, we also saw US regulators stepping in to investigate, although it was later found that there may not have been violations. So, I mean, of course, freight cost is just one small part of the whole picture for eggs demand and supply growth. So while current freight rates have that short to mid-term impact on markets, there is that longer-term outlook piece for Asian eggs as a whole that we shouldn't ignore and that I'm sure Liz will have a better perspective on.
Maybe Liz, you can add that perspective here.
Yeah, sure. I mean, raw material cost is a major component for feed costs, right? Which affects the cost of meat and final finished products. But how the companies deal with this cost, either by absorbing it or passing it on, it depends on their overall business strategy. And cost is not driven higher just from freight, but from many, many different factors, just like Bao Ying has mentioned. So the freight impact is not just felt in Asia, it's inflating costs globally. And not just the Asian agri-commodities that are facing challenges. So, I mean, I guess to conclude, we can say maybe with vaccines being rolled out later this year, countries preparing to lift restrictions on travel and movement, like travel, the demand for pandemic-induced consumer products will fall. People would want to have more experiences like cruises or going on driving holidays and dining out. All this would reduce the strain on the supply chain.
I think you just covered a bit of my conclusion here. So maybe even Bao Ying can add to this. How do you see the future of freight? Do you see it stabilizing by maybe, like Liz said, end of Q3? Or do you think uncertainty will continue?
Yeah, I think there are a lot of predictions in the market right now on freight rates. There's also a lot of demand for predictions in the market, as one can expect. But I think coming after a year like 2020, where most of the market was reacting and adapting to truly unexpected changes. Personally, I'm a bit hesitant on making one, which I know is not very helpful because decisions need to be made, budgets need to be planned. But I think that's the state of things right now, where people are making decisions with the best information they can get at this point. And from our perspective, our role here is to report the market as we see it happen, to maintain that level of transparency in the market. So my team, we assess spot prices regularly and push out analysis feature pieces on containers at Platts. So I'm happy to have a chat with anyone who will find that useful. But that being said, I think the general expectation is that this could last well into the next few months as the supply of space catches up with the backlog of demand for space. So there are some who think that the market will be very firm in the coming month, especially for those who couldn't get their volumes out before Lunar New Year. So carriers are trying to catch up with demand. We've heard there are some advances, but there are also bottlenecks that persist, like manpower at the ports. And these are still going to be there, and they're going to need a bit more time to be worked out.
Thank you. I think our listeners can follow S&P Platts for future updates and changes in the market. Thank you, Liz and Bao-Ying, for your valuable insights today, and it was a pleasure talking to you.
Thank you, Zara.
Thank you.
So, what are the takeaways from this podcast? First, it looks like the uncertainty in the freight market is going to continue for at least until the end of this year as demand for goods and freight keep up. Second, factors such as bullish crude oil markets, sustained premium prices for shipping, and a large backlog of demand for space are going to keep freight markets firm, at least for now. Thank you for joining us on this podcast. Don't forget to bookmark our website www.asian-agribiz.com or subscribe to this channel on Spotify or iTunes. This is Connie Pereira wishing you smooth sailing ahead into 2021.